Hello and welcome to this video about The Intelligent Investor by Benjamin Graham. Graham is widely regarded as the father of value investing, and his book has been a timeless classic in the world of finance and investing for over 70 years. In this video, we'll explore the contents of the book, some of the key ideas and concepts, and some of the examples and case studies that Graham presents. So, whether you're a seasoned investor or just starting out, there's something to learn from The Intelligent Investor. First, let's take a look at what The Intelligent Investor is all about. The book is divided into two parts. The first is focused on investment principles, while the second is focused on analysis and selection of individual securities. In the first part, Graham lays out his philosophy of value investing, which is based on the idea of buying stocks at a discount to their intrinsic value. He also discusses the importance of diversification, the dangers of speculation, and the need to maintain a long-term perspective when investing. In the second part, Graham provides a detailed framework for analyzing individual securities, including stocks and bonds. He introduces key metrics such as earnings per share, price-to-earnings ratio, and book value, and explains how to use them to identify undervalued or overvalued securities. He also discusses the importance of understanding the company's financial statements, and how to use this information to make informed investment decisions. Let's drive more detailed breakdown of the first part of The Intelligent Investor, which focuses on Graham's philosophy of value investing. 1. Value investing. Graham's philosophy of value investing is based on the idea that the stock market often misprices companies, which creates opportunities for investors to buy stocks at a discount to their intrinsic value. 1. Intrinsic value is the true value of a company, based on its earnings, assets, and potential for growth. Graham argues that investors should focus on finding companies that are undervalued by the market, and hold on to them for the long term. 2. Diversification. Graham also emphasizes the importance of diversification, which means spreading your investments across a range of different companies and industries. Diversification helps to reduce the risk of your portfolio, since if one company or industry performs poorly, the impact on your overall portfolio will be less severe. Graham recommends holding at least 10 to 15 different stocks in your portfolio, and spreading your investments across different industries and sectors. 3. Speculation. Graham warns against the dangers of speculation, which he defines as buying stocks based on rumors, hype, or short-term market trends, rather than on sound analysis and research. Speculation can be tempting, especially during times of market volatility or when a particular stock or sector is in the news. However, Graham argues that speculation is a risky and unreliable way to invest, and that investors should focus on long-term value instead. 4. Long-term perspective. Finally, Graham emphasizes the importance of maintaining a long-term perspective when investing. He argues that short-term market fluctuations and volatility are often driven by emotions and speculation, rather than by underlying changes in a company's value. By contrast, a long-term perspective allows investors to ride out the ups and downs of the market, and to focus on the fundamentals of a company's financial performance and potential for growth. Overall, Graham's philosophy of value investing is based on a disciplined and patient approach to investing, focused on finding companies that are undervalued by the market and holding onto them for the long term. He emphasizes the importance of diversification, caution against speculation, and the need to maintain a long-term perspective. These ideas have been influential in the world of finance and investing for decades, and continue to guide investors today. Now let's jump to the second part of The Intelligent Investor, which focuses on Graham's framework for analyzing individual securities. Framework for analysis. Graham's framework for analyzing individual securities is based on a set of key metrics that he believes are crucial to understanding a company's financial performance and potential for growth. These metrics include earnings per share, EPS. This is the amount of earnings a company generates for each share of stock outstanding. Graham argues that companies with consistently high EPS are likely to be strong investments. Price-to-earnings, P/E, ratio. This is a measure of how much investors are willing to pay for each dollar of earnings generated by a company. Graham argues that companies with low P/E ratios are often undervalued by the market. Book value. This is the value of a company's assets minus its liabilities, divided by the number of shares outstanding. Graham argues that companies with high book values relative to their market price are often good investments. Understanding financial statements. In addition to these metrics, Graham emphasizes the importance of understanding a company's financial statements, which provide detailed information about its revenues, expenses, assets, and liabilities. Graham provides practical advice on how to read financial statements and use them to make informed investment decisions. Examples and case studies. Throughout the second part of the book, Graham provides numerous examples and case studies to illustrate his ideas and concepts. For example, he analyzes a variety of different companies and industries, and provides detailed commentary on their financial performance and potential for growth. One famous example is his analysis of the cigar butt stock, which is a company that is undervalued but has only a limited amount of potential growth left. Graham argues that such stocks can still be profitable investments if purchased at a significant discount to their intrinsic value. Another case study that Graham presents is his analysis of the enterprising investor, which is an investor who is willing to do more in-depth analysis and research than the average investor. Graham argues that the enterprising investor can achieve better results than the average investor by taking a more active approach to investing. Overall, the second part of The Intelligent Investor provides a detailed and practical framework for analyzing individual securities. It emphasizes the importance of key metrics like EPS, P/E ratio, and book value, as well as the need to understand a company's financial statements. By following Graham's approach, investors can make informed investment decisions and increase their chances of success. So, what can we learn from The Intelligent Investor? First and foremost, we can learn the importance of a long-term perspective, a focus on value, and a commitment to disciplined analysis and research. We can also learn the dangers of speculation and the importance of diversification. Ultimately, The Intelligent Investor is a must-read for anyone interested in finance and investing. Its timeless wisdom and practical advice make it a valuable resource for investors of all levels of experience. Whether you're a beginner or an experienced professional, there's always something new to learn from Benjamin Graham's classic work. Thank you for watching, and happy investing.